Welcome to the PlanStrongerTV market update for Wednesday, August 12th. Roll right into the numbers. There are your 2025 total return numbers. You can look down the screen there and see strong year for 2025. And let's look at 2026. Boy, we're off to really a remarkable year all the way through July, now into August. Again, raw numbers, year to date, not annualized. I looked down that list and I'm like, I'll take it right now, punch my card and I'll go home. So all numbers up and including small cap, almost 23% year to date, making a strong case for the value or opportunity that can present itself with a well-diversified portfolio. All right, so Robert, we'll talk a little bit. Anything that stands out about the market, the indices we're tracking, anything that you said, whoa, look at that, or that I didn't expect that. Well, although you expect a lot of things, Robert. Anything that kind of said, I want to comment on that.
Well, looking at the numbers this morning and inputting the fresh numbers from last week, some went down just very slightly. We're talking hundredths of a percentage point. Some went up, but international stocks actually went up more than 2% since last week. So that was kind of an eye-opener this morning.
Okay. And again, that also makes the case. We hear so much about the domestic market, the Magnificent Seven, and what the tech stocks and what the AI stocks or the chip stocks are doing. But it's a big world, and diversification around the world can definitely be an advantage, especially when we get to times of volatility. So that's one of the things that Robert wanted to talk about. I'm like, what are we talking about today, Robert? And he said, I want to get to volatility. And it's a good time to talk about volatility because we're not in the middle of it. We talk about volatility, usually what we mean is high volatility. People don't really pay attention to volatility until it smacks them in the face, right?
Exactly.
It's like, oh, the market can go down. Wait a minute. I've been enjoying these great returns. What's going on? How did I get here, right? So what exactly do investment people, when people hear about it on the news, what does volatility mean for them, and how can that relate to or be something that the investors understand better?
Well, I love when David talks because it gives me so much food for my response. David mentioned a couple things. He's like, usually when volatility is high, stocks are going down. And but what exactly is volatility? When you look at volatility, what it is a price of whether it's a stock or a equity index or even a bond index, and the variation of that price from a mean or its average. So when we talk about high volatility, what we mean is somebody is expecting, let's take oil, for example, with the Iran conflict. Now, oil's going to spike really high, but somebody else is saying, you know what, there's going to be a resolution and the oil price is going to go down. So you have a data point here and a data point here. And the greater distance between those data points, the higher the volatility, because expectations are all over the place. For, let's say, a bond. Okay, now, yes, interest rates can change, and they can change dramatically. We've seen that in 2022 and 2023. But with a bond, usually the day-to-day price movements are based on the small yield movements. So the price changes are much smaller, meaning that's why fixed income overall usually has much lower volatility than, let's say, a chip stock. So that's what actual volatility means, is the price discrepancy higher or lower from your average or the mean of that stock.
So it's the amount of change up and down, basically, in a given stock or equity or frozen orange juice concentrate, whatever it is. Now, what do we call, Robert, when you have not just volatility, but it is happening quicker? So we have to factor in time, because if something goes up and down, it's kind of like it could be a big wave, but it's kind of this big gentle wave that's going versus very choppy.
Yes. So when you're talking volatility, you're correct. I neglected to mention, the volatility over the last 3 months, 1 year, 5 years. But when it happens very quickly, that's when we say volatility spikes, it's because something unexpected has happened. Okay. And based on that unexpected data point. It can be housing data, energy price, it can be anything. But when there's a large deviation from expectations, that's where you get one group of people saying, oh, I'm going to buy, and another group of people, oh, I'm going to sell. And that's where that extreme price differences happen. And yes, those happen in a very short period of time when something unexpected happens and the time frame is very condensed. That's really, like you said at the outset, when people think of volatility, they think of those volatility spikes.
Okay, good. I'm going to stretch the analogy with the waves. So if somebody is looking at volatility and they are concerned about it, and again, nobody's worried about volatility to the upside, it's the downside. What do you say to them, Robert? What are some of the ways that people can, quote unquote, reduce the volatility of their investment portfolio?
I'm going to take that one step further, David. So usually how we respond, oftentimes we respond by saying if you're worried about volatility or you're worried about the market, to kind of reduce risk. But that's the usual response. But let me take that a step further. There are several responses that one can take to volatility, David. And let's say you're in a 50% equity and 50% fixed income, and that's your plan. You're comfortable with half equities, half bonds. But if there's a spike in volatility, which usually means prices are dropping, maybe that can be a buying opportunity. So of course, when fear grips the markets, only a small percentage will say, let me take advantage of that and buy. It's usually the impulse is to sell, sell, sell. And guess what? A lot of people do that, which is why stocks continue to go down, down, down in a volatility spike. But the ones who keep their heads and say, you know what, maybe it'll go down even further, but now is a really good price to buy these stocks and maybe increase my portfolio, sell a little bit of bonds of the fixed income, 5-10%, and buy the drop in equity prices. So there are different ways, not just, okay, well, here's volatility, let me step back. Definitely reevaluate your portfolio. Definitely reevaluate, as David would say, the proximity to you, the use of your money. But it might be not now, but during the volatility spike, when, as Warren Buffett says, when everybody
when the tide goes out, you find out who's been swimming naked.
And when times are good, people are greedy, but when times are bad, the smart people get greedy.
Right.
So so there are different ways to respond to volatility. The main point is, take a step back, take a deep breath, and think, how can I use this to my advantage and my portfolio's advantage?
That's good. And Robert, I like to steal Robert's comments sometimes. He got mine about proximity to use. One of the ways that you can also address volatility, which is looking at this over a longer period of time. A wave moving towards shore, it may be very long, right? And it's not perceived as volatile. So if we have a longer period, if it's 10, 15 years before you're going to use the money, then short-term volatility really doesn't impact you. Yes, exactly what Robert said. Check your portfolio, make sure it still aligns with your long-term strategy. Maybe it has gotten, quote unquote, out of whack for some reason, either poor performance, unexpected performance, shifting of the strategies, whatever's happened. But in terms of saying, well, I've got to do something because of the short-term volatility, even though I have a longer-term plan, that can really trip us up. And now, when I say, respond to this urge to do something, doing nothing is doing something, because what you're doing is you are actually saying, my allocation is proper, I'm going to keep it. Keeping something is doing something. Doesn't mean you have to react. And it's not unusual for investors to say, oh my gosh, this is bad. Oh my gosh, my account's going down. Do something to their financial person. And the financial person often says, well, hold on. Let's talk about what you are trying to accomplish. No, I just don't want to lose money. Okay, well, great. Nobody likes to have to stop at a red light either. I mean, it's the nature of driving. You're going to hit a red light. You're going to run into some bumpy turbulence on the flight with your stocks and your equity or fixed income investing. So I think that we've got to step back and take a look at that and, be prepared for when these times come. And it has been a while since we've had a significant drop in the market. And I don't want to be a naysayer or, negative, but it is real and normal to have markets go down 5%, pull back, 10% correction. It's normal. It's not unusual. And so, we'll see what comes. But often it comes, we talk about the data, and Robert does a great job of talking on the update about the data that we look at and to look below the headlines, all of that. He mentioned before about the volatility increasing because new data that's come out that wasn't expected can trigger volatility because everybody's kind of recalibrating. So it's a correction or a bear market, 20% drop. They don't usually show up. Well, here we go. Let me check my watch. The bear market's going to show up next week. It doesn't come that way. It comes on the heels or because of something throwing a wrench in the system that isn't expected. And everybody's like, wait a minute, let me figure out where my investments need to be, because often a bear market's caused by more people wanting to sell than buy.
Exactly.
All right. Yep. So these are your cautions. But again, the market is doing well. We see a lot of positive returns. We're not saying that, any of this is going to stop, but it doesn't go on forever. And so when volatility presents itself, stop, pause, look at where you are. You need a second opinion. You need an investment review with your financial person. All that's good. But we just don't want to do anything radical or rash.
Exactly.
Final thoughts.
When some bad metric comes out and increases volatility, yeah, it's okay to say, wow, that housing data was horrible. Oh my gosh, that metric was bad. But there's always a bright side to volatility, bringing asset prices back down to earth. So look at a full picture. Don't just look at the data point as, being bad and now volatility hit.
Yeah, I want to piggyback one more thing on that. That's good, Robert. Nobody likes to sell when their account is down in value. But if it's your regular money, your non-qualified after-tax money, and your portfolio is quote unquote gotten out of whack for whatever reason, the values being down, you're going to trigger a lower tax by considering a reallocation. Now, I think, and we subscribe to this philosophy, that if your account needs adjustment, it needs adjustment. I would rather make 75 cents try and accept the fact there's a 25% tax than to accept 100% loss. In other words, I'd rather have a gain than be like, well, but I didn't pay any tax. Yeah, but you lost money. So it's okay to pay tax with getting your portfolio properly calibrated. Okay, one more time. Final thoughts?
We're good.
Okay, we'll stop there. We could keep going. There's a lot to talk about, but that's enough for today. And we'll continue to monitor the markets and be back soon to help you continue to plan stronger.